Hey, this is Sasha, and I want to share with you some insights today on another episode of Let's Talk Stocks, episode number 182. Today, we're going to be focusing in on the Federal Reserve along with the inflation target that they talk about and show you some proof in the pudding that inflation is running way higher, possibly, at least in certain sectors, than they projected. Now, keep in mind, the Federal Reserve, of course, before we get started, it talks a lot about the inflation target. Really, it just means that, the price of goods continues to go up, which also means the value of your money continues to go down. So meaning a box of cereal from $3, this year might cost you $3.25 in a year or two. So it just continues to rise with time. Now, they look for a 2% inflation target. But remember, when you look at cans, ice cream, 100 years ago, it might be 9 cents, or a hamburger might be 5 cents or 50 cents. Prices definitely have increased over time, and that's what they continue to do. But I want to share with you some very hard facts to show you where price increases are really starting to skyrocket, at least in certain sectors, out of control. So here, first, let's take a look at some of these things and take a look. Really, the Federal Reserve right here was the big announcement here the other day. They didn't change the rates, and I believe they didn't do that because they wanted to do it maybe more when there was a speech coming out as well, so they could kind of back it up and talk about it and discuss it, because if they would have changed it maybe without the speech, it might have been a little too aggressive. The market did sell off. In fact, it's selling off right now. If we look at it right here, we're down to like 33, 35, almost 40 points we were down. Had to do some adjustments and hedging a little bit more so than I wanted to, but that's what the market's doing. So anyways, basically the Dow declines after the Federal Reserve keeps rates unchanged. We had a pullback towards the close that previous day on Wednesday, and now we're getting a follow-through day on Thursday. Market's definitely acting weak. Now, my key thing today for you is to share with you the issue we have with the economy and really why things are slowing down, and you're paying for things much more now. Now, I'll show you in some sectors because we've had earnings released. I'll show you in these specific sectors from the restaurants like Chipotle, McDonald's. We'll also look at Amazon Prime and Apple as well. So I want to back these things up. But again, keep in mind, I'm only looking at a few close, tight-knit sectors, which we just recently had earnings, which companies boasted about their profits and their record earnings. But a lot of this is due to inflation, which is kind of interesting. So anyways, keep in mind that when the Fed looks at the rise in the inflation, they're looking at overall everything, I guess, the economy for the U.S. and so forth. I'm just looking at a few sectors, but I'll show you as a consumer, the inflation is way higher than what the Fed really states. Now, granted, these are over a couple of years, because Chipotle, let's take a look here. Chipotle has raised prices at its locations. It's one of the things that made that stock pop in a big way, because they've hit some targets. And you can see that stock popped and exploded very high there from kind of these lows, and then exploded and moved well. But when you look at the percentage increase, okay, so again, their prices were kind of similar and the same over a few years. So the rise in the inflation, they're also raising prices, but that raise is 5 to 7%. Right? So 5 to 7% raise, and now they're rolling out to more and more locations with the price increase. So when you look at buying, let's say, a $10 meal between whatever you're getting, the drink and your burritos, you're going from a $10 meal times that by 5 or 7%. So you're going to pay $10.50. Now you multiply that times a couple of 100 million burritos, and you're starting to look at some serious money and cash flow. Now, as far as now looking at the general public, that also means we're spending more money for lunch, right? So you look at this, the same thing goes with McDonald's. Look at it. Big Mac rise, McDonald's hikes Coca-Cola meal prices due to sugar tax. Well, they could blame it on whatever. It doesn't really matter. But basically, you look at this. When was this one? April 2018. So April 2018, on the 6th of April. So anyways, you look at this, and again, look at McDonald's here. If we take a look what happened, of course they popped here after earnings. Now we are getting a little pullback and just market's weak, but overall they like this, right? Investors like this because McDonald's is making more money, but you as a regular person paying more to go out to eat, because you look at this, McDonald's pushed the price of Coca-Cola and meals by as much as 12% due to new sugar tax. So again, they pushed this again, 12% give or take, 12 to 14% on their products. So you go from Chipotle 5 to 7%, here McDonald's about 12%, and here I'll give you the biggest one. Look at Amazon Prime. A lot of talk about this one, $20 bump. Now they've had the same kind of price throughout, and they're trying to continue to give you more and more services. That's one way to justify inflation, right? So one way that companies use this to disguise things is the inflation part, because it happens, right? This is part of doing business, is they add more into it, right? They add more, like for example, instead of just having movies, now you have movies and music. Instead of just having movies and music, now you can also get free 2-day shipping. So they continue to stack services, and now you're getting a $20 bump into that Prime membership. So it goes up to, I think, $119 or $120 per year. So you're basically, about a 20% jump. So think about it. You got a 5%, 7% in Chipotle. You got like a 12, 14% on McDonald's. You got a 20% here on Amazon. And here's what's interesting. Look at what companies are trying to do as well. Here's Apple earnings, right? Apple sold only 3% more iPhones last quarter, but profits increased. Well, why is that? Well, the rise in prices increased. This is one of the ways that it's disguised. Of course, they'll mention other things. Oh, there was Super Bowl commercial and this kind of thing due to marketing and buyback programs and all these kinds of things. But really, you look at why is it that they thought about this, making this iPhone X $999. Now, yes, it didn't sell amazing or anything like that, but they're able to make much more on that on the margins. Excuse me. So by doing this is a way to disguise inflation, because Apple's not selling soft drinks, right? They're not raising their iPhone by 50 cents to sell, millions. They're raising it by a couple $100 on average, so that way they could sell these more expensive phones. And now customers will start justifying and becoming the new normal, right? It's like when gas prices were $1.14 and then gas prices went up to about $2.20. It started to normalize things, and then they went up to $3 and then back down to $2. It's now normal to have gas prices $2.20, $2.50, $3, or right under $3, at least in the US. It's not normal to have gas prices 99 cents a gallon, and it's not normal to have it $5, $6 a gallon, at least not in the United States. In Europe, maybe that's a different story. So this is what's happening, is that now they're trying to normalize that, hey, if you want a phone, the normal rate, is going to start to creep up, $800, $900, then $1,200. You'll see $1,500 phones, because they're trying to pack more and more things into it. Apple Pay, Apple Music, all these kinds of things. They'll put it into your watch, start integrating things. And this is the way it works. That's inflation. And it just means you're paying more money overall, which means you have less money to spend on other things. So when you multiply that times hundreds of millions to hundreds of billions of dollars across consumers, basically a lot of money is being lost or basically gained by the corporations, but you as a regular individual, you're going to have less money in your pocket. And that's really what it all comes down to. So looking at individual companies, as we start looking at it, let's look at a few of the more popular ones. And I'll just go into a few of my common lists here. So as we look at Apple, you can see the earnings did beat, or looking at it, it went well with investors, right? You had increase and rise in volume, and now we're getting a pullback. Now, my concern here with when things pop like this is take a look at what happened with Netflix, right? You had a nice earnings and you got a sell-off effect. So the same thing here with Apple. You had nice earnings. Well, are you going to get a sell-off effect? Because you have to fill that gap, right? So that's a little bit of a caution. And when you look here at the S&P here, down about 30% points, in fact, starting to pick up and accelerate speed. So this could actually become even more of a problem. Amazon, the same thing. You had nice earnings, 1600, but a rollover. Again, are we coming back? So that's also a problem. Looking at some, let's take a look at Facebook here. Also another popular company. So you could see here, little digestion, but here was earnings, big pop, moving sideways, but are we going to roll back over? 170 is kind of key in your line in the sand. Google, also $1,000 is your key support level. If we roll under this, this could be trouble, right? Again, these stocks are at critical levels. Now, they can have some really nice bounces. When you get these sell-offs, you can get some real nice bounces. I will tell you that. You can get some real good pops, whether it's Apple, Netflix, Google. But you need to be careful at that we're in some of these key critical support levels, because if this starts to roll over, you could be in a mess of trouble at 900 and then get even to lower prices. So it can start taking things out pretty quickly. So that's a little bit of a concern for me just overall. Look at Johnson & Johnson now breaking this key support level. It was hanging around here for a couple of months, 3 or 4 or 5 months. And now we're breaking it. So we're basically under this moving average. So we're rolling over. So here's our moving average. If you look at kind of the daily on the 200-day, we're under. And this right here is your key support. We're under there as well. So your next stop for this, I mean, really 110 could be another $10 lower from this. We talked about Procter & Gamble, which was similar to Johnson & Johnson. That right here, 70 was the key. And you look at it, it's coming right into that, right? So you're coming right into that. Now, that doesn't mean you're not going to get a few bounces here, right? It doesn't mean you couldn't have gotten a few bounces even here. All it means is 70 has a potential to bounce. Now, does that mean it can't slice through this like butter? No, you could slice through it like butter. I just think in the short term, it's oversold, right? So you typically don't get, how shall I phrase it? When you drive a car and you're looking to get from destination point A to point B, you don't just keep driving for 45 hours straight, okay? You will take pauses, bathroom breaks, you'll need to refuel, that kind of thing. So think of this as like driving a car, whether it's to the upside, like a rocket ship, or whether it's to the downside, like a jackhammer trying to drill to the center of the earth. You need a break, right? Whether that's to refuel, one way or another, have a drink, take a pause, the same thing here. So you can see, even on our way down, we had a few green days, they weren't really strong. So even here, you're about due for a little bit of a break, meaning a little bit of a pop, even if it's, to 75 and then roll back over, right? Now you could come back and to retest the 80s, but I'm talking about this with a mess of stocks, right? When they sell off for a big period of time or for a longer period of time, right here. So let's say after earnings, well, that's why you get this little counter trend bounce. That's what happens. You need a break, a digestion, because the shorts will take some profits, that kind of thing. So there's always breathers in there. So anyway, getting back to our Johnson & Johnson here, you could see selling off. This could be a problem. 120 is potential support right here. You have a little bit of support at 120, but really that 110 level looks very attractive for me. It's right around that level. So looking at it, you have a few areas here that 110 is key. And if it gets there, that could be a nice value buying opportunity for at least a shorter term bounce. Now, again, you'll have to reevaluate it at that time, but that could be a nice area. McDonald's, again, 165 was the resistance level. It broke out of that, but the second day, it didn't have strength. Normally, strong stocks and strong economies, you'll get a second or third day follow through. In this case, we got a 1 day bounce, nice earnings for the company itself, but overall sold off, partly due to the gap, but also just overall the market's acting weak. So 155 is your key line in the sand. That's your support level. Let's take a look at PayPal. 70 is key. We're getting there. If this rolls over, you could see a mess of trouble because the support line right there is there's not a lot of them, right? Not a lot of price support levels. I mean, you can hit like, let's say $60, $65 at any given point and create a support level, but overall 70 is the key for that. And then let's look at Square here. Also holding up at 45. That's the one we're watching here, and 50. It's still just kind of moving around sideways there. So anyways, those are just some thoughts. Oh, one more thing. Tesla kind of had an interesting earnings call, I guess they say, on this. Elon Musk was talking about, hey, if you're a day trader and you don't like the volatility of the stock, you don't have to buy it. It's kind of true. It's right. If you don't like the stock, then don't buy the stock. Kind of simple, but a lot of investors think, well, you shouldn't have said that, you shouldn't have done that. Well, the reality is if you're trying to day trade it, well, then you need to be prepared for the consequences, that it goes up and it goes down, moves around pretty quickly. He's trying to run a company, right? That's the thing. He's not looking to please shareholders. He's trying to run a company, but this is selling off in a big way. And this is partly also another reason beyond the Fed that kind of push things lower. So anyways, with this in mind, I want to thank you so much for joining me in this Let's Talk Stocks episode. We have some great things coming out here in the future over the next couple of months as far as video courses go. So make sure you get on the newsletter list by clicking this button. When you get there, enter your name and email address. That way you can get notified as those things are released on promotions and other additional details. But if you want to just hang out on YouTube, hit the subscribe button right here on my face. And then I'll see you in the next video. Thanks again. I'll see you next time.